Wow, good. Actually, I'll lose these. Good morning, everyone. I really appreciate people taking time out. I'm not sure I got anything that exciting to say, but I put some slides together, so we'll run through this. Also, leaving a lot of time for Q&A, which probably more interesting than the prepared slides. Let's start with oh, hold on. I think I do this. There we go. Okay, so let's talk a little bit about what FF Venture Capital is. We're a seed stage firm. We like to start when companies are just getting going. We started 14 years ago in the US. We have an office in Warsaw. We've been here a couple of years. I don't want to say we're the only US seed stage firm with an office in Warsaw, but I don't know of any others. Our focus really is to help companies grow. And we're not an incubator. The company trips over its shoelaces, we're there to help it step up. And so we have very high survivorship. And that bleeds through into having a number of sort of top quartile funds. We run an active platform. We organize 200 events a year. We have a newsletter with over 20,000 recipients, goes out twice a month. And it's focused on not just the US market, but the Warsaw market as well, and what we're seeing over here in Central and Eastern Europe. We're the only VC firm to have actually founded an accounting firm. It's kind of weird because VCs, we look at numbers all day, but there are very few VCs who actually are chartered accountants, CPAs, and the like, and they seem to have a problem with numbers. And we built a front office VC platform to really help manage all the things the GP needs, called Totem VC. So we're a little different in our approach. So I've put a number of these slides in between. They have absolutely no relevance to what I'm saying today, other than I just think they're pretty cool quotes. So, everything you can imagine is real, I think, is very relevant to startups. It's very relevant to VC, and it's very relevant to Picasso. So as I talk to people, everyone's focused on the current instability. I had a conversation before I came in here saying, thank goodness for the global pandemic because it really prepared us for World War III. And I said, that was not a sentence I expected to hear 2 years ago. So we're always focused on the current instability. We feel everything's stable in the past because we dealt with it. But I remember how each of these felt. I even remember the 87 crash. I go back a little longer. Stuff happens in the world, and we hit periods of instability. Startups are inherently dealing with problematic situations all the time. They can be macro, or they can be relevant to that particular company. Startups fundamentally are bankrupt organizations until they're generating EBITDA, and they're dependent on the kindness of strangers. So, we've had a lot of instability in the past. We're seeing some current instability at the moment, and we're trying to work out how to deal with it. In 97, I'm not going to read this, but feel free to read the slide. In 97, there was this great article in Wired magazine talking about the long boom. And like a lot of ideas, when people stop talking about it, it probably happened. Like we stopped talking about the paperless office, but guess what? We're in the paperless office. You pick up your laptop, you go home, you can work. That's because we're in the paperless office. In the same sense, I truly believe we're in the period of a long boom where technology is just enabling so much prosperity, so much efficiency, so much disruption. And I don't see it ending yet. And then, it was talking about 25 years in 97, which is kind of like ends next year, but I don't think it ends next year. I think it carries on. And I think we're very blessed to live in such interesting times driven by this. So, given all that, the four most dangerous words investing is this time's different. And at some level, I think this instability is different. You do have this long tech boom. You've had this long period of relative stability. And Minsky's hypothesis is the longer the stability, the bigger instability. And I think we may be hitting one of those moments right now. We've had ridiculous interest rates the last 22 years. So much so we feel it's normal, and interest rates now going up feel weird. I don't know if they'll sustainably be able to go up, but that's a different issue because of all the money printing. The rolling pandemic, in the US, it's fundamentally over, except for California. Not because of facts, just because of approach. But in China, it's just getting going because they were able to keep it out for so long. So it has to burn through there, and that is obviously going to impact a lot of supply chains. And then, yes, war. And none of us know the outcome there, and we all hope this evil atrocity will end soon, say the least. Now, these are the things that really give us pause. And as VCs, we invest against disruption. So we're coming to the end of the Bretton Woods Accord, post-World War II, of expanding globalization. We're going to see increased localization. To use simple language, do we want the robots in China or do we want the robots in the US and in Europe? And I think we want the robots locally. The cost of moving goods is going to go up because of what's going on with energy. There are national security concerns. It is very peculiar that most of the medical drugs that are used in the US come from overseas. That, I think, will change on a national security perspective. It's also interesting most of the illegal drugs come from overseas, but that's a different issue. For many years in the US, a lot of VCs did not want to fund military technology. I think that naivete is going to change. We've got inflation, we've got bankrupt companies, we've got unrest coming, food riots, all of that dynamic from what you're seeing with regard to fertilizer, wheat exports, et cetera, from this war. And something is happening, and I can't fully articulate it yet, but in the US, we are seeing a housing boom that I think is going to just continue. It may end. We're already stretched affordability and the like. But it looks like people want bigger houses in places they want to live because they can work remotely. And remote work has gone from probably 5% of workforce hours. It'll probably stabilize somewhere around about 25%, which is a massive shift. And a lot of startups have gone remote first out of necessity. They're hiring the best person they can get, not the best person they can get in a zip code that can commute to an office that they don't now dominate where they live. And that is having impacts because if people aren't using location as a way to resolve, then certain cities become less important with regard to startups. And I think you're getting a spreading out of entrepreneurship, which I think is actually very positive for inequality. VCs are worried. In 2008, Sequoia put out their 100-year flood deck, where they said things are tough, batten down the hatches, etc. Didn't really happen in the startup world. And now we have Redpoint putting out this presentation, where this is what they think is going to happen. And they just see this as the beginning of, really needing to batten down the hatches, and things are terrible. They put out a chart here saying that if funding over the next 4 years is similar to what happened post the dot-com bubble, this is what we're going to see. It's going to be a disaster, etc. I don't buy this. But you should consider it and think about whether it happens or not. In TechCrunch, Carter put out this survey where they said the amount raised per round is going down, valuations are going down. Yeah, maybe. People refer to the Series A crunch, the Series B crunch, etc. There's always a crunch. It's the nature of the game. You have 100 companies in the US raise a Series seed, 30 raise an A, 10 raise a B, one goes public. It's crunch all the way. There's nothing particular about now versus anything else. But great companies can raise a ton of money at great valuations. There's more money in the ecosystem than ever has been. And good companies will get funded and hopefully less bad companies. There is a reason why it's called venture capitalism and not venture socialism. Right? It's about creative destruction, not creative pay your salary for the rest of your life. An appropriate quote, actually. So I think what the gist that you're kind of getting here is we live in disruptive times, but we always have. So we have a company in Ukraine. It's actually a Delaware C Corp. The IP's out. They've done all of the right planning ahead of time. Some of the people are still in Ukraine. It's a great company. They do what's deep fake audio. So I could sound like Tom Hanks, which I think my wife would appreciate. But no one cares on that one. It's used by Disney and other folks to replicate voices exactly as they want them to be, whether it's Luke Skywalker's or someone else's. They had this Russian aggression plan. They were a little shocked at the speed it went through. However, they've regrouped. They're doing record revenues. They're actually profitable this last month. And, I've got other VCs approach me like, how do we invest in the next round? And it's like, what world are we in where on the one hand, there's a war in Ukraine and half the teams in Ukraine on the other hand. So I think great companies will be able to raise money under adverse conditions. I can't think what's more adverse than this. And I think people should dial it back a little with concern. VC is a long-term investment strategy, and the short-term twists and turns are the things that we help companies navigate around. So what's a VC to do? We lean into disruption. We're fundamental investors. We're not momentum investors. We think there's a strong European technology opportunity, especially in Poland. That's why we opened an office in Warsaw. We actually anticipate post the war in Ukraine that Central and Eastern Europe is going to get increased focus, increased investment at all levels across society, and we'll actually see a very strong growth coming out of this, as long as we avoid, World War III. And do understand one thing. I'm a VC, so I'm wrong many times. So don't, take this as our central thesis, but we always reserve the right to be wrong, and our failed investments remind us when that happens. What's a founder to do? So in the US, where you're a little further away from hostilities here, take your commute time, and in the US, commute time's longer than here, usually about an hour each way. Take your commute time and reinvent the world. We've already, I referred to Long Boom, this amazing set of tech stacks and rails have been built that allow us to grow companies at incredible rates. Lean into disruption, hire the best talent from anywhere in the world, and we're seeing that. We're seeing equalization or narrowing of disparity of wages for engineers everywhere. And just understand you live in a chaotic, volatile world. You always have. You might look stable in the past. It really wasn't. And run a low burn model. Get early revenues. Listen to your customers. And build a business. And put robustness in. Think about the what ifs. What do we need to do? Have an invasion plan if you're in Central and Eastern Europe. Not that you think things are going to go that way, but as a leader, guide your people if they're anxious. And this is an important point, I think. And this is very much a US perspective, but I think it's worth sharing. Go big. Build a massive business if you can. If you fail, it's only a big business. Don't try and build a decent-sized business, because the opportunities out there, the global audience, the receptiveness to new technology from enterprise is massive. And so aim high, because this is a world in which a lot of people are able to actually hit the target. Another appropriate quote. And honestly, this is how I like to live life, which is, you aim high. If you fall a little short, you still did some decent damage. And where to do this? Well, Poland. We think there's a great nascent ecosystem, which is why we set up the office here a couple of years ago. There are an incredible number of talented people here and coming, and not just, from Ukraine. And there are really good mentors here who just want to help. And you can leverage that to grow your business. And then this is one of my favorite quotes that I think really applies to entrepreneurship. And Michelangelo was a visionary on many levels. And I think that's all my prepared comments. So let's get into the more interesting part here. Let's do some Q&A. If anyone has any question, I guess put up your hand. Maybe someone will bring you a mic. I'm not sure how we're organized here. Someone help me out. Elsewise, I'm going to be hanging. I might have to start singing or something, which is terrible for you.
Hello, my name is Kamil from Experty. I'm just wondering if your VC company planning to go into cryptocurrencies, blockchain investment, or just traditional one?
Okay, so the question is, what do we think about blockchain?
Cryptocurrency.
And cryptocurrency.
Yes.
Yeah. I'm going to make a lot of enemies. So on this one, we have not made an investment in a company in the crypto space. We've looked at it. We look at decks every week of companies in the space, and we are looking to find one company that fits a simple test we have for pretty much every company we invest in. Is this solution 10 times better or 1/10 the price? We have a company in Ireland, Manna, that does last mile delivery of food by drone. Ridiculous on so many levels, which is why we like it. They believe they can get the price of delivery down to €1 versus 8 to 10 euro. Passes our test. But when we look at blockchain solutions, they can often be met with centralized databases. And so to use distributed needs to be both necessary and sufficient, and either drive a solution that's 10 times better than an alternative or 1/10 the price. We haven't found it yet. We're waiting for that Netscape moment. It's a bit like 93 if someone said to you, wouldn't it be great if someone could connect all the world's computers together and they could talk to each other? And I go, well, yeah, I guess I have good conversations, but how's that help me do stuff? How's it help me run a business? And then Netscape came along and we had the browser, and that unlocked, all of the potential we see. The same thing with mobile, and that unlocked a lot of potential. So we're waiting to see that potential unlock. Now, there have been infrastructure plays that have worked, and as long as you had a view that cryptocurrency really was going to be around a long time, those plays would have worked. We didn't have that view. And I think from a trading perspective, from a crypto hedge fund perspective, makes sense. But for a venture capital firm that's buy and hold, we haven't yet really seen that. Now, we're maybe naive, we may not know enough about the space, but we'd love to find something that resonates with us.
Thanks.
Yes, sir. Please pick up a mic.
So hi, I am Grzegorz from Arya Fund, and question, since like you're active both in the US and in Central Eastern Europe, is there anything particular about Polish or Central European teams or Central European founders that you, for example, don't see in the US? Or is it just that you're seeing that, for example, the quality of the teams is converging? Like, how do you compare the quality of the teams and quality of the founders and the direction in which it is going, between those two worlds?
So I've said for a long time that I think the world is flat and unevenly distributed. And we decided to foray into Europe about 4 or 5 years ago, and we did a lot of work. We felt that Warsaw and Dublin were two areas that had nascent ecosystems. We felt like New York had all of the right things in place to grow significantly. We didn't know what to expect with regard to European founders. We now have approaching a dozen investments in Polish Nexus companies. Some are in Poland, some are in Estonia, and other countries around here. We're 6 months, a year in, we get to know the teams, they come over to New York, we're kind of a bridge to them. And I spent quite a lot of time with a fair number of the teams. I have been blown away by the quality of the founders. I have been really surprised at how quickly, how they listen, adapt, build business model. And so I think there may be a perception in the US that because the market isn't as developed over here, the companies aren't of the same quality, capability, and nonsense. Phenomenal quality, phenomenal opportunity. And maybe it's a little self-selection. One of the things I hear is that sometimes European companies don't want to go big. They don't want to grow fast, etc. We're not finding that with the companies we're working with. So I think that where there's a will, there's a way, that if the entrepreneur is driven to make this really work, it doesn't matter where you are. It's kind of interesting. When I was a kid, my parents bought for myself, my two brothers, a set of Encyclopedia Britannica. Some of you may not even know what that is, but it's like this amount of books, and it had, description of everything. It's an encyclopedia. And I remember my brother got a detention because he wrote a book about airplanes, and he just cribbed it out of it. And the teacher knew this because the last sentence said, "see balloons." But now, everyone's got the sum of human knowledge in their pocket. It's a supercomputer, and you can play Candy Crush, but you also can look up, how to build your own solar rooftop installation. So the fact that you have this has democratized information in a way that's never been before. And so I'm just incredibly encouraged by what we're seeing. We're seeing great companies. I think there's going to be great things that are going to happen. It takes time. Venture's a slow business. I can't think of a slower business than venture. I tell people that the second decade of being a venture capitalist is more fun than the first one, because at least you've got companies that are 10, 11, 12 years old, and huge and doing fun stuff. But it's a slow business, so it'll take time. It'll take 10, 20 years for this to become evident to everybody. But I truly believe there's tremendous capability here. There's tremendous talent, and it should just be encouraged and nurtured.
So when you say that Central European founders do not like the ambition to go big, what do you think is then in their way at this point?
So I'm reporting what other people have told me. The founders I've met, I've not really seen that reticence. But sometimes it's literally I don't want to use the term insecurity or the like, but it's probably they just haven't seen it done before. Silicon Valley, I think, as a concept, will look quaint in 20 years, because I think with what's happened with the pandemic, a lot of talented people have left there to go to other areas, and it's sort of equalized things within the US, and I think it's equalizing around the world. So I think people just have to believe it can be done. And by the way, there's a TV series, I think it's HBO, called Silicon Valley. I think there's 4 seasons. If you haven't watched it, please do. The first one is like the first season is a comedy. The second one is a pastiche. The third one is a documentary. It's like just so much embedded good information within it. But yes, I think it's simply a matter of understanding what you can do and how you can do it, and just getting educated.
So I guess we have to share more success stories.
Share more success stories, absolutely. And what we found in the US, and I think you're going to find here, is successful people who make money as entrepreneurs, want to give back to community, they want to become angel investors, they want to be mentors, they want to start accelerators, start VC firms and the like. And I think that cycle takes time, but I think we're going to see that here.
Hi, Arthur from Ovens VC, so the funds based here. I have a question regarding your view on valuations. I have met opinion that scissors are even more broader, so the best companies, but the best in a way that they are growing like four times a year or 3 times a year, and has like really huge market. They still get that amazing valuation, but then even good companies and mediocre companies are going to struggle a little bit with funding. Yeah, and so what do you think about it?
Valuation is actually a very complex subject, and there are things that are pulling in different directions. So where to start? So let's think about this pandemic, right? We all were at home. Some of us were wiping down our, groceries as they came in, keeping away from people, masks, blah, 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 right? But we picked up our laptops, we went home, and we're probably as or more productive than being in the office, which was kind of weird. But imagine that the pandemic had hit 20 years ago. Firstly, you didn't have a laptop, you had a desktop. So you'd have to carry it, home. And then that wouldn't be very good because the checkbooks were in the office and the paper records were in the office, and none of the systems all the systems weren't on your computer. And even if they were, there wasn't enough bandwidth to do Zoom calls. You have little postage stamp things that look grainy. That's the best video you could get 20 years ago. And Zoom couldn't have scaled because the rails they sat on couldn't scale, etc. So we came into a period, this long boom, where all the rails were built, so Zoom could grow by orders of magnitude We could all have high bandwidth video conversations instantaneously. We could learn how to do this because the user interfaces were designed to be very easy, unlike the ones 20 years ago, which you scratch your head. So we're very lucky the pandemic hit now. And the economic impact was much less because of that. So understand where we are today. Companies can grow faster than they could ever grow before. And if a company can grow faster, it can have a higher terminal value. And if valuations are a DCF against terminal value, maybe valuations should be higher. Now, when a lot of founders talk about valuations, they're really saying, what's the price of my next round going to be? What dilution am I going to suffer? And we tell founders the dilution you suffer is how you spend every dollar between the round, not where the round is. If you spend the money accretively, your valuation will be higher. If you spend it dilutively, your valuation won't be that much higher. And so that's how you should think about dilution, which is the sort of flip side of valuation. There is a lot of money out there. There will continue to be a lot of money out there. At the margin, may there be less or more. You know, I still don't think putting money in your bank for 50 basis points is that attractive. Maybe 1%, 2%. Maybe if I put money in the bank for 6%, 7%, maybe that'd be attractive. I don't think we'll get there. And if we do, there's a lot of other stuff that's going to get dislocated in the interim.
I think on the left,
There's a lot of money in this space because this is the place where growth is. The Fed, since March 2000, has held interest rates artificially low. It's de-alphaed almost every strategy. But growth exists here because Manor, when they deliver something, they can deliver it cheaper than having an Uber driver sitting in McDonald's to pick up your McDonald's and taking 28 minutes to bring it to you when it's sort of soggy warm, right? If they can do that and deliver it in 3 minutes, a better experience, it's 1/10 the price, that's just going to happen. And that's growth. And it's going to enable a whole new series of businesses can sit on top of that infrastructure they build. That's growth. And growth should get funded, and growth will generate a return, right? You've got commodity markets you can trade and stuff, but this is real underlying growth that exists within startups across the board. And so the money's here, good companies will get funded. Maybe there's some dumb companies that are getting funded that shouldn't. Maybe some companies are getting funded at valuations they shouldn't. But that's up to the discipline of the VCs to communicate. Because we as VCs, we look at thousands of companies a year. We have a bigger data set to think about where valuation should be. But there's a couple of thoughts there, if that helps.
Digging a bit on the valuation, because what we saw in the public market is that many tech companies just went down like 50% or 75% in some cases. Even UiPath, which is like the biggest tech story from the CE, and a lot of it was attributed to rate hikes, fake Fed policy, etc. Do you see anything of that happening in the private market? Or is there like those two markets live together? Or maybe you just think like our focus is so long term that it like doesn't matter if the Fed hikes the rates 1 or 2 or 3% for that sense.
It does matter. So a couple of thoughts here. One is, as VCs, ultimate buy and hold, long-term investors for growth. Our companies grow revenues each quarter, year over year, somewhere in the 25 to 40% mark. Other things being equal, if that continues, we think our valuation should grow at that, right? But multiples can come in and they can expand, and that can be driven a little bit by the sentiment in public markets. Now, public markets are momentum. Right? No one wants to buy stock going down. Everyone wants to buy stock going up. People will pay higher prices for something, not lower prices. It's just how it's the George Costanza mentality that's embedded in the public markets. And by the way, before I was a VC, I was at Goldman 21 years, and the last 11 years on the sales and trading floor covering hedge funds. So I have some experience with public markets. I think an analogy I often use with people to think about public and private markets is think of the sea. At the top of the sea, there's a storm. There's a storm going on now. We're in a bear market, I believe. I think this recent rally we've seen is going to be crushed back down. We'll probably take new lows. I think the technicals are weak. But there's a storm at the top of the sea. And then the surface waters are pretty churned up. But the deeper you go, right, there's less sort of disturbing of the water. So seed stage is very low, and it's had very little relevance there. Later stage, near the surface, it has. I spoke to a growth manager who said Q3 we were 6 times fund. By Q4 we were 3 times fund. I'm like, wow, that's pretty bad. You know, it's like a hedge fund without the hedge. And they were buying pre-IPO companies with a view that between the period they buy and the end, multiples don't compress, and they're right 9 years out of 10. But in that 1 year, it doesn't work. It doesn't work. Well, we're not seeing that because we're across the stack. Because we got very early companies, we got later companies, and you blend it. You know, our median duration is less than theirs. But yeah, it has an impact, and it is relevant. And for some of the frothier stuff, it can certainly impact. But if the companies are growing 50 to 100% year over year, you got to see a lot of multiple compression to not recognize that the company is getting more valuable over time.
So you mentioned management accounting. How do you deal with small, young companies that have not much experience with that, getting in place kind of management accounting that is the foundation for the next growth?
The question is, how do we help them think about their numbers, about accounting?
Well, I mean, typically, it's statutory accounting. That's kind of the basic stuff that everyone's dealing with. But then getting up to management accounting, understanding the real margins of the business, et cetera, how they grow, that's an important part. But I think that's not very typical in Central Europe that you find people that understand the management accounting.
Right. So that's like a really softball question for me, because prior to my 21 years at Goldman Sachs, I was at Arthur Andersen, I qualified as a chartered accountant. So for those in the room who don't know the difference between financial accounting and management accounting, most accounting firms who work with startups do financial accounting. Here's your balance sheet, your extended trial balance, your P&L, flow of fund statements, and that's about it. But we think management accounting is very important. You have one product, what's your contribution margin? You have 2 products. What's the contribution margin of each? Right? Product line P&Ls, very important. That's why we built an accounting firm to provide management accounting support to our portfolio companies. It's called Graphite Financial. When it got to about 40 people, we spun it out because I didn't want to manage 40 people. But it's out there, it exists. We feel that about 10% of startups fail because they don't know their numbers. Very rarely is a CEO an accountant. And they don't know what they don't know, so they lean on their accountants. Their accountants provide them financial accounting information that's insufficient. If you have a negative working capital model, one where you get paid before you have to pay, and you're growing fast, that's wonderful. You start to grow a little slower, all your cash disappears. What happened? Right? So accounting can be very relevant. VCs don't talk about all the accounting screw-ups that companies have, but I think about 10% of companies fail because of that. So yes, we think it's very important. We believe CEOs should make number-informed decisions. So understand your margins. And it can get complicated. You have a marketplace where you're trying to build supply and demand. Understanding your cost acquisition is really difficult. Knowing your margins are really difficult. And a lot of marketplaces, I think, fail because neither they nor the VCs around them nor anyone on the board understands this. So yes, strong belief in management accounting. It's very important. There's a question at the back here.
Hi, Adam from Bowweb. You said that Central European companies don't dare to go break so quickly. What's your general view on, let's say, a company from Warsaw or Central Europe? Should they grow first here in Central Europe or go immediately to the US? Do you see a point in growing in Central Europe and then maybe a little bit broader, let's say Europe or Western Europe, or you advise companies to go to the US right away?
It depends on the company and depends what you're selling and the like. I will tell you that my answer today is different than it would have been 2 years ago. 2 years ago, I'd say build big in the local market and then work out how to go global. I think we're at a point where, because of the pandemic, we've broken the notion of location. We have a company called Secure, growing rapidly. They raised around a $4.5 billion valuation recently. We led the seed round. They used to be a New York firm, New York head office. They came into 21 with 184 employees. They exited 21 with 450. They now have about 650. They want to end this year with about 1,000 employees. And around about December last year, I spoke to the CEO and I go, how do you think about remote? He goes, the vast, like over 50% of our employees aren't based in New York anymore. I've actually moved to Park City. We're not a New York firm anymore. We're remote first. We had to be. We just hired the best people. Why focus on people who just could commute to an office in New York when we weren't even occupying an office in New York? And so, and I don't think he cares whether they're in the US or if they're in Warsaw. If they're the most capable person to do the job, he's going to hire them. And so I think location has broken down. In addition, remember I talked about all the rails being built? There are companies out there that allow you to hire employees in any country in the world without you having to actually set up an office, because they're an employee of them. They're like a super PEO. So I think given where we are, given the tech stack, given things have been built, location isn't that relevant. So if your company, it's easy to sell into the US, sell into the US. If the experimenting locally and building a brand locally is the right strategy, do that. It very much depends on the company. So there's this new paradigm here that I think is just a little bit different. Do we have time for one more? Or I think we're out of time, folks. I really appreciate you having me here today. This is a lot of fun. I'll be around for any other questions, and thank you very much for coming today. It's going to be a great summit.